The bottom line is that anybody can do this. Anybody can invest. You don't need to make six figures. You don't need to be a millionaire. You don't need a financial advisor. You can do this yourself. This is the simplest way to get started investing in 3 easy steps. What is going on, YouTube? Welcome to my channel where I talk about finance, fitness, and travel. If any of those things interest you, please subscribe and follow along for more. 3 steps to get started investing. Before you even get started investing, you must be a good steward of your finances and understand that this takes patience, discipline, and time. This is not a get-rich-quick thing. The money that you invest should also not be money that you're gonna need within the next 2 years, maybe even 5 years. And the money that is invested is subject to market volatility, meaning that the value of your money can go up or go down. But in this video, we will go over how to invest to have the least amount of risk possible. And the easiest way to reduce risk is to have a diversified portfolio. So in this video, we will not be going over stocks. We will not be going over what are undervalued companies that you need to invest in now. Like, this is not one of those videos. This is for the person that just wants to put money away, just wants to see money grow over time, and doesn't want to stress about rebalancing their portfolio, selling these stocks, buying these stocks, timing the market, none of that stuff. This is the simple and effective method. So instead of investing in stocks, we're going to be investing in mutual funds. Think of mutual funds and ETFs, exchange traded funds, like a basket of hundreds of stocks. So if Apple isn't doing well today, your investment isn't going to take such a big hit because you probably have 100 other companies within that specific mutual fund or ETF. That also means if Apple goes up 50% in one day because of some random reason, your investment isn't going to go up 50%. It's going to go up, but it's not going to be as drastic. The difference between ETFs and mutual funds is that ETFs can kind of be traded like stocks within your brokerage account, meaning that you can like buy and sell whenever you want. Buying into mutual funds are executed once a day, typically after the market closes around 4 p.m. Eastern. That's pretty much the only difference. Now let's get into exactly how to get started. Step 1, you need to open an account. You can't buy and trade stocks in a checkings account or a savings account. You have to open what is called a brokerage account. The staple companies are going to be Charles Schwab, Fidelity, and Vanguard. I personally use Charles Schwab, and there are a bunch of newer companies that are way more intuitive, that have a better interface, that have apps, all of that cool stuff. But again, we're doing simple and effective. So you don't need any of that new age tech. We just need a reliable company to open our brokerage account in. And for this example, because I use Charles Schwab, we're going to use Charles Schwab. On the Charles Schwab home page, you're going to see a button that says open an account. Click that button, and then you're going to see the options of accounts that you can open. To quickly gloss over them, the IRA accounts are going to be your individual retirement accounts. Similar to your employee-sponsored 401k, these are retirement accounts that you personally can open and fund, but you have to wait obviously until you're like 59 and a half or 60 years old and retired to access the funds penalty free. So in this example, we are going to open an individual brokerage account. So it's not a retirement account. This is a brokerage account where you can trade ETFs, mutual funds, and stocks. What I love about Charles Schwab is that you need $0 to get started. You can literally open the account for free. There are other companies that require a minimum deposit of like $200 up to like $3,000. Charles Schwab is free. Just open the account. Step 2 is, you guessed it, we have to fund the account. You need money to buy into the mutual funds. The best way is to connect your checkings account and set up automatic and recurring transfers from your checkings account to this brokerage account. Keywords: automatic and recurring. The key to investing and actually seeing your money grow is through contributions. This is not dump $200, wait 50 years and expect $1 million. You have to consistently contribute to this account. If you're like me, I am not the best with money. I like to spend, I like to travel, I like to buy. So I need an automatic and recurring system so I can set it and forget it. So that is exactly what you need to do. I don't care if it's $10, $20, or $100. whatever you can. Okay, now that we have money in the account, we jumping into step 3. We have to invest the money. If the money sitting in this account is not invested in anything, it will not grow. It's just going to be like a checkings account. It's just sitting there as cash. And I know, oh, what do I invest in? What are the stocks? I hear AI is taking off. Should I just buy some AI stock? No, stop. This video is not for the day trader. This video is for the simple Joe Schmo like me, and you just want simple and effective way to invest. And the answer is one specific mutual fund. That's it. And the mutual fund that we are choosing is one that tracks the S&P 500. The S&P 500 is an index composed of the top 500 US companies. That's going to be your Apple, your Microsoft, your Facebook, or Meta, Google, Tesla. All of those companies are in the S&P 500, and the mutual fund that we will be trading is the Schwab S&P 500 mutual fund. As you can see, the objective of the fund is to literally track the S&P 500 index fund. My comments will probably be flooded with, oh, you need at least 3 funds. You need to put money here. You need to split it this way. Listen, the S&P 500 has done well historically. If it ain't broke, don't fix it. I'm giving you peace of mind to make this a sustainable approach, because you need to do this consistently with discipline, and it has to be sustainable. What I love about the SWPPX mutual fund is that you don't need any money to get started. There's other mutual funds like at Vanguard, you need a minimum $3,000 to trade their mutual funds. With Schwab, you just do it with $1. Just do it with $2. It doesn't matter. When I started investing, like I think 7 years ago, I was doing like $20 every 2 weeks. Like that's what I could afford. It takes time, but I will say, do not get started investing if you are not a good steward of your finances. I said it in the beginning of the video. If you have credit card debt, if you have any high interest debt, if you don't budget, if you don't have an emergency savings account, stop this video, get out of this video, watch one of these other videos that I have up top, because you need to do that first. We should not be risking dollars when we have credit card debt or no savings account and no emergency fund. No. But if you have all of that, continue watching. Another reason why I like this fund is that it has super low fee. You're talking about 0.02%. That means for every $1,000 you have invested, this fund will charge you 20 cents. Why does this mutual fund have any fees regardless? Like, there's people managing this mutual fund. Like, it's not automatic. There's fund managers. They have a salary. So, you know what I mean? Now that we know which fund we are going to be investing in, you need to now set up auto and recurring investments into that mutual fund. Keyword, automatic and recurring. So we have the automatic deposits from our checkings account into the brokerage account, and now we're going to set up automatic investments with the money that was deposited to invest into the SWPPX mutual fund. So now let's get into what you care about. Okay, how is the fund performing? That's what I want to know. If I put money in, how much money am I going to have in 20 years? Hold on, take it easy. We're going to get there. So I'm using a tool called the Backtest Portfolio Visualizer. What it does, it takes the fund, the stock, the ETF that you want to analyze, and it tells you how much your money would be worth if you invested in that specific equity over 10 years. It's using real data to tell us the performance on our investment. So there's a bunch of things here. I'm going to make this super simple. I'm all about simplicity. The name of our portfolio, I'm just going to call it what we're going to invest in. SWPPX. Okay, cool. So that's portfolio number 1. We're not comparing any other portfolios. We're just seeing the performance of this specific investment. So asset number 1 is going to be the mutual fund SWPPX, and we're investing 100% into that mutual fund. Analyze portfolio. Great. The highlights is that over 10 years, this mutual fund had an average return of 13.5%. Considering you're getting 0.01% in your checkings account, considering you're getting 3% in a savings account, that's amazing. Can you make more trading stocks? Can you lose more trading stocks? Yes. Again, this is a low risk approach to investing, but it's easy. Now that we know the 10-year average return, let's actually work out an example and put the numbers to work. Calculator.net has an amazing feature called an investment calculator. Our starting amount is $0. You don't need any money to start. We're going to be more conservative. It said 13.5, but let's just say 13%. And we're going to contribute $500 a month. Look, if you cannot afford the $500 a month, it's okay. I started at $50 a month, $20 every 2 weeks. Sometimes 25 bucks. Everybody has a starting point. Work with what you can, but work towards being able to invest more. After 5 years of doing this, you will have over 40 grand. 5 years? Oh my gosh, 5 years? You know how quick 5 years flies by? It feels like yesterday and we were suffering the COVID pandemic. That was like 5 years ago. It feels like yesterday I just started working. That was 5 years ago. 5 years goes by like this, and you know it does. So don't give me that. Give yourself 5 years of investing $500 a month. You're going to have over 40 grand. What does that look like in 10 years? Congrats. You got 6 figures in an account. For the folks watching that are like in their 30s and their 40s, you've been working for like 20 years. What do you have in your savings account? Do you got 6 figures in there? If you do, yo. I'm not even being sarcastic. If you do, that's fantastic. If you don't, we got to change something. In 20 years, you're going to have over $500,000. If you start at 30, you're going to have over $500,000 by the time you're 50. 50 years old with $500,000 sitting in a brokerage account, that's not counting your 401k. That's not counting if you own property, if you own a house. That's not counting a savings account. The goal to real wealth is adding all of these things that you're doing and then combining them at a certain point in time in your life. And that might be different for everybody. That might be 60 retired. That might be 50 retired. That might be 40 retired. Don't look at this account as like, oh, that's it, 500K and I'm 50 years old. No, you should have other things. This requires no effort from you. Only thing you got to do is make sure you have the $500 a month to get these numbers. You don't have to worry about, oh, what am I investing in? Oh, did it go through? Or, oh, it's the 15th. I have to make that transfer. No, because everything's already automatic. It's automatic. For shiz and gigs, 30 years, over 2 mil. This is the power of compound interest. And if you look here, very, very important. Out of the almost 2.2 million, how much actually came out of your pocket out of those 30 years? 180 grand is what you contributed in 30 years to an account that's worth almost $2.2 million. And that is because of the interest, the return, the 13%. 180,000 might sound like a lot of money to a lot of people. It's really not. If your rent is $3,000 a month, in 5 years of renting, you would have paid 180 grand. Sorry. That's reality. I'm not here to sugarcoat anything, but that's reality. Let's look at these same numbers, but if we were just going to have it in a high yield savings account. I'm not dishing high yield savings account at all. If you want to put money away at a guaranteed safety, federally insured, up to 250,000. Some are like $1 million. This is no risk. High yield savings account is essentially no risk. Obviously, if there was like a world war and all the banks blew up and there's a whole different problem, that's a different situation. But we're not talking about Armageddon here. Monthly contribution, $500. The percents for the high yield savings account are like 3 or 4%, to be honest. Interest rate at 3.5%. Let's do 30 years. 300 grand. That's a lot different from 2.2 million. Again, I'm not dishing high yield savings accounts. I love them. They're a fantastic tool, but they don't compare to investing. To build wealth, saving money in a savings account will not build wealth. Investing will build wealth. Increasing your income will build wealth. Owning assets will build wealth. Savings is for emergencies and to save up for a big expense that's going to come within the next 2 or 3 years. The bottom line is that anybody can do this. Anybody can invest. You don't need to make 6 figures. You don't need to be a millionaire. You don't need a financial advisor. You can do this yourself. This is the simplest way to get started investing in 3 easy steps. I hope you enjoyed the video. You liked the video. If you did, please give it a thumbs up. Please comment. Helps my channel grow. And if you enjoy content like this, please subscribe and stick around. I would love to have you.